Hey option traders, for today's trade we're looking at a bull put spread in electric vehicle maker Tesla. As many people know, the stock is set to report earnings today after the close with an expected move of around 9.1%. So taking a look at the stock on MarketSmith, Tesla was one of the worst performing stocks in the last 12 months, but has since shown some signs of life, bouncing over 17% so far this year. Last week the stock retook its 21-day line and the 50-day moving average is now very close. The stock holds a very low RS rating of 5, which exemplifies its severe underperformance over the past year. This sort of rating makes it very difficult to consider buying the stock outright at this point. But what if there was a way we could get bullish without having to buy the stock? Well, we can, using options. A bull put spread is a risk-defined way of getting long. This type of trade allows us to structure an option trade where we think the underlying stock will stay within an expected range and the response to the earnings report will be positive. A bull put spread here is one of the 4 basic vertical spreads you can put on using options. It involves selling one put and buying a lower strike put. This creates a credit as the more expensive option is sold. The goal is for the stock price to stay above the higher strike price to keep the full premium. If the stock price is below both strikes, the maximum loss will be realized. If the stock price is between the 2 strikes and held until expiration, you will be assigned the stock. This means that you will be acquiring the shares in the option. Overall, it's best to close the position before expiration. So with all that said, let's take a look at my trading platform and set up this trade in Tesla. So to set up this trade in Tesla, here is what we want to do. First, select vertical as your spread type here in this box if you're using Thinkorswim, and then make sure you are looking at the January 27th expiration date, which is this Friday, but that's okay, that's the point of the trade since it is an earnings trade and earnings are due today. And then we're going to look at the middle of the screen for our strike prices. We're going to be clicking on this side of the screen, which has prices for put options. And we're going to use this strike price pair here and adjust the 127 below. So we are looking to simply sell one 128 put and buy one 123 put. Using the January 27th expiration, we could sell the 128 put and buy the 123 put. In total, this spread will generate around $60 in premium, with a maximum risk of $440. That represents roughly a 13.6% return on risk between now and Friday if Tesla stock remains above 128. If Tesla closes below 123 on the expiration date, the trade loses the full $440. The break-even point for the spread is 127.40, which is calculated as 128 minus the 60-cent option premium per contract. There is little room for adjustment with a short-term trade like this, and the trade also contains assignment risk. A 14% return in a few days would be nice, but the possibility of losing 100% is also very real. As such, this style of trade is only for traders with high risk tolerance, and you should definitely use appropriate position sizing here. As always, remember that if you're new to options, make sure you practice with a virtual account before risking any real money. And remember that options are complex and in some cases investors can lose 100% or more of their investment. Be sure to join us here for our regular options content where we discuss new trade ideas every day.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube. If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.